You watched the setup form. You saw the level. You knew the structure, but you waited because it was not quite there yet, because one more confirmation would make it cleaner, because patience is a virtue and you were being disciplined. Then price moved, fast, green candles stacking, momentum building, and something happened inside you that had nothing to do with analysis. A feeling, urgent, visceral, impossible to ignore. I'm missing it. 3 words, and everything changed. The disciplined trader who was waiting for confirmation became someone else entirely. Someone scanning for any reason to enter, any justification to participate, any argument that it was not too late. So you clicked, and the moment you entered, the market slowed. The momentum faded, price consolidated, then reversed. And you sat there, stopped out or underwater, asking the same question you have asked 100 times before. Why does this keep happening? Here is the answer. You were not trading a setup. You were trading a feeling. The feeling of being left behind. The feeling that the market was moving and you were not in it. The feeling that everyone else was profiting and you were watching from outside. That feeling has a name, FOMO, fear of missing out, and it is one of the most expensive emotions in trading, not because it is irrational, but because it feels completely rational in the moment. It feels like recognition, like opportunity awareness, like the correct response to a market that is clearly moving, but it is none of those things. It is fear wearing the costume of analysis. And in this video, we are going to examine exactly why FOMO appears, what is happening neurologically when urgency overrides discipline, and what the internal shift looks like that separates traders who chase moves from traders who wait for them. Let's go deep. Part 1. The fear of missing opportunity. Markets move constantly. Charts never stop printing candles. Price never pauses long enough to allow perfect certainty. And because of this constant movement, traders develop a belief so subtle it rarely gets examined directly. If I am not in the market, I am missing something. This belief operates quietly in the background of every session. It creates a low-level pressure that is always present, even when there is no clear setup, even when conditions do not justify a trade. The mind scans. It looks for movement. It searches for participation, because participation feels like engagement, and engagement feels like progress. But here's the distinction that changes everything. Movement is not opportunity. Opportunity requires structure. Movement simply requires volatility, and the market produces volatility constantly, every session, every hour, every candle. But genuine structure, the kind that carries a statistical edge, is rare. When traders confuse movement for opportunity, they are essentially treating every candle as a potential trade, every price shift as a potential entry, every moment of momentum as a signal. And the result is not better participation in genuine opportunities. It is constant exposure to noise, noise that costs capital, noise that drains attention, noise that slowly, invisibly, erodes the edge that the system was built on. Part 2. The neuroscience. Why FOMO feels like insight. Let's go inside the brain. Because FOMO is not a personality flaw, it is a neurological response to a specific type of stimulus. And understanding it at that level removes the shame from it and replaces it with something more useful: awareness. The brain has a region called the nucleus accumbens. It is central to the dopamine reward system, and it is exquisitely sensitive to one specific type of signal: reward that is happening right now. When price breaks out strongly, when green candles stack and momentum builds, the nucleus accumbens activates. It recognizes the pattern. Something valuable is occurring. Something is being gained. And it generates a powerful motivational signal. Get involved now, before it is over. This signal is not analytical. It is chemical. And it is extraordinarily difficult to override with willpower alone, because the dopamine system operates faster than conscious thought. By the time your prefrontal cortex has formulated the question, "Does this meet my criteria?" the dopamine signal has already been present for several seconds, already influencing your perception, already narrowing your focus onto the moving price, already generating reasons why this time is different, why this move is the one worth chasing. There is also a second neurological layer that amplifies FOMO specifically: loss aversion. As we explored in the revenge trading video, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain would be. Now apply that to a missed trade. Watching a move develop without you is experienced by the brain as a loss, not a neutral event, not simply an opportunity that did not meet your criteria. A loss, something that was available and was not taken. And because loss aversion makes that experience twice as painful as a gain of the same size would be pleasurable, the urgency to correct it becomes overwhelming. The need to get in before it is entirely over becomes a biological imperative, not a strategic decision, a survival response to perceived loss. This is why FOMO is so difficult to resist through discipline alone. You are not fighting a bad habit. You are fighting a hardwired neurological response that evolved over millions of years to prevent loss. In a trading context, that response makes you buy late every time. Part 3. The moment FOMO appears. Let's walk through this in real time. You are watching the market. You have your plan for the session. Your criteria are defined. You are waiting. A level forms. Price approaches a zone you have been watching. This is close to your setup, but not quite there. Not yet. You wait. Then something changes. Price breaks sharply. One strong candle, then another, then a third. The move you were watching for has begun, but it began differently than you anticipated. It did not form the way your plan described. It moved before full confirmation arrived, and now it is moving fast. Your attention sharpens. Everything else on the chart disappears. Your focus narrows entirely to this one move, this one set of candles, this one opportunity that is happening right now without you. The thought arrives with force. I should be in this. And immediately behind it, if I wait any longer, it will be too late. Your hand moves toward the entry. You tell yourself this is a valid trade. You find the argument for it. The momentum is strong. The direction is clear. It is obviously moving. What more confirmation do you need? You enter. And one of three things happens. The first possibility, price continues and you profit. This is the FOMO trade's most dangerous outcome because it teaches you that chasing works. It reinforces the behavior. It makes the next FOMO trade more likely. The second possibility, price consolidates and eventually moves in your direction, but not before stopping you out of your late entry first. The move you predicted happened. You were just positioned incorrectly to benefit from it. The third possibility, price reverses entirely. Your late entry was the exhaustion point. You provided exit liquidity for the traders who entered when the structure was clean. In 2 out of 3 scenarios, the FOMO trade either damages you directly or teaches you the wrong lesson. And the one scenario where it appears to work only makes the next one more likely. This is why FOMO compounds over time. Not because traders lack discipline, because the variable reward structure of occasional wins makes the behavior neurologically sticky.
Part 4. Social comparison and the amplification of FOMO. FOMO does not exist only between you and the market. It exists between you and other traders. And in the age of social media, that dimension has become more damaging than ever. Screenshots of profitable trades, posts about the move that just happened, comments in trading communities about the breakout everyone else caught. Each of these inputs amplifies the feeling that you are behind, that other traders are capturing opportunities you are missing, that the market is producing wealth for everyone except you. This social dimension of FOMO changes behavior in a specific way. It transforms trading from a probabilistic exercise into a competition. And when trading becomes a competition, the criteria for taking a trade shift. Instead of asking, "Does this setup meet my defined criteria?" the mind asks, "Am I keeping up? Am I missing what others are capturing? Am I falling behind?" That shift from criteria-based to comparison-based decision-making is one of the most destructive things that can happen to a trader's execution. Because comparison has no relationship to edge. Being in the same trade as other traders does not improve the probability of that trade working. It simply means you are in the same position as people who may themselves be operating from FOMO. Professional traders are largely immune to this social dimension, not because they are emotionally cold, but because they have learned to measure themselves against their own process rather than against other traders' outcomes. Their benchmark is their plan, not someone else's screenshot. And that internal benchmark, stable, personal, process-based, protects them from the comparison trap that undermines so many retail traders. Part 5. Buying high and selling low. The mechanics. Let's examine what actually happens in the market when FOMO traders enter. By the time a move feels obvious, by the time the candles are stacking and the momentum looks undeniable, the majority of informed participants have already entered. The traders who identified the structure before the breakout are already positioned. The algorithms that detected the pattern are already in. The professionals who had orders waiting at the level are already holding. When FOMO traders enter late with urgency, they provide exactly that. They buy the position at the elevated price. They take on the risk the early participants are now managing. And the moment sufficient FOMO buying has absorbed the early participants' supply, the move stalls. The momentum that looked unstoppable simply runs out of new buyers, and price reverses. This is not manipulation, this is market mechanics, supply and demand operating exactly as designed. The FOMO trader, entering at the peak of obvious momentum, is structurally disadvantaged, not because they lacked skill, because they entered at the point in the trade's life cycle where risk is highest and reward is lowest. Late entries have narrow reward potential because the move has already partially completed. Late entries have wide risk because the entry is far from the original structure that justified the trade. The risk to reward of a FOMO trade is almost always poor, and poor risk to reward repeated consistently guarantees negative expectancy, regardless of win rate. Part 6. Lessons from professional traders. The most instructive thing about how professionals handle FOMO is not what they do, it is what they have learned to feel. One principle shared consistently among experienced traders is this: a missed trade is not a loss, it is the cost of having standards. When a professional watches a move develop without them, a move that did not meet their criteria, they do not feel urgency. They feel confirmation. Confirmation that their discipline worked. Confirmation that they protected their capital from a trade that was not theirs to take. That reframe from missed opportunity to confirmed discipline is not natural. It is built through deliberate repetition of the correct internal response, through choosing again and again to measure success by process rather than by participation. Another principle observed among professionals who have traded through highly volatile, momentum-driven markets: the best trades never feel urgent. When a genuine high-probability setup forms, when the structure is clean, the confirmation is present, the risk is defined, the correct response is not urgency, it is calm recognition. A clean setup invites participation. It does not demand it. Urgency is the signal that something emotional is driving the decision, not something analytical. When you feel urgency before a trade, that urgency is not excitement about a good opportunity. It is FOMO activating. And FOMO trades, taken with urgency, rarely end well. The third principle, widely observed in professionals who have built sustainable track records: there is always another trade, not as reassurance, as mathematical fact. Markets operate continuously. Structure forms regularly. The same patterns that produced edge yesterday will produce edge again tomorrow. The specific trade being missed right now is not the last opportunity that will ever exist. It is one trade in an infinite sequence. And treating it as irreplaceable, treating the urgency to participate as justified, is the cognitive distortion at the heart of FOMO. Part 7. The psychological reframe. The shifts required to overcome FOMO is not behavioral, it is perceptual. You do not need to try harder to resist FOMO, you need to see the situation differently. Currently, when you watch a move develop without you, your brain processes it as, "I am missing an opportunity." The reframe is, "I am watching a move that did not meet my criteria." Those two statements describe the same event, but they produce completely different emotional responses. The first creates urgency, the second creates neutrality. And neutrality is the foundation of clean execution. The practical application of this reframe is a single question asked every time FOMO appears. Not, "Why am I missing this?" but, "Did this move meet my plan?" If the answer is no, if the breakout happened before confirmation, if the entry level was not clean, if the risk to reward was poor from the late entry, then the correct response is not urgency, it is acceptance. Acceptance that this move was not yours to take. Acceptance that discipline means watching some moves develop without participation. Acceptance that a missed trade that did not meet criteria is not a failure. It is the system working exactly as designed. That acceptance, practiced deliberately, repeated consistently, gradually rewires the brain's response to missed moves, until the urgency fades, until FOMO loses its grip, until watching a move without entering feels less like loss and more like exactly what it is: professional execution. Let's make this concrete. The first tool is the pre-session opportunity definition. Before the market opens, write down exactly what constitutes a tradable opportunity today. Not generally, specifically. What structure is required, what confirmation is needed, what the entry level must look like.
This definition becomes the filter through which every potential trade is evaluated. When a move begins and FOMO activates, you return to the definition. Does this match what I wrote? If yes, act. If no, watch. The definition prevents FOMO from redefining opportunity in real time. The second tool is the post-move review. Every time you watch a move develop without entering, write down why. Did it not meet your criteria? Was the entry level compromised? Was the risk to reward poor from the late entry point? This review does two things. It confirms that discipline was the reason for not entering, not hesitation, not fear, not poor analysis. And it builds a record of the moves you correctly avoided. Reviewing that record over time reveals how often the moves that triggered FOMO subsequently reversed, how often the urgency you felt was pointing you toward a losing trade. That evidence, accumulated over weeks, is more powerful than any motivational statement about patience. The third tool is the FOMO interrupt. When you feel the urgency to enter a move already in progress, impose a mandatory 2-minute pause. Do not close the chart. Do not look away. Just watch for 2 minutes without touching the entry. In those 2 minutes, one of two things happens. The move continues, in which case you can assess whether a genuine structure has formed and whether an entry still makes sense with defined risk, or the move stalls or reverses, confirming that the urgency was FOMO, not edge. 2 minutes of observation before a FOMO trade prevents the majority of late entries. Because FOMO depends on speed, it requires momentum, both in price and in your decision-making. The pause breaks the momentum of the decision, and without momentum, FOMO loses most of its power. The fourth tool is the missed trade log. Keep a record of every trade you watched but did not take. Note whether it met your criteria. Note what the outcome was. Over time, this log becomes one of the most valuable documents in your trading education because it shows you, with your own data from your own sessions, the true cost of the trades you correctly avoided and the true cost of the ones FOMO convinced you to take. That comparison, seen clearly over weeks and months, changes the emotional experience of missing a move permanently. Closing. Every move you missed was not a failure. Some of them were discipline. Some of them were your plan working exactly as it was designed. Some of them were the market testing whether you could be trusted to wait. And the ones you chased, the ones where the urgency won, those were not opportunities. They were lessons. Expensive ones, but lessons nonetheless. FOMO is not something that disappears. It evolves. As your career develops, the intensity of it reduces, the grip it has on your decision-making weakens, not because the market becomes less stimulating, but because the evidence accumulates. The missed trades that did not meet criteria, reviewed honestly over months, reveal a pattern. Most of them were not worth taking. Most of the urgency was noise. Most of the moves that felt unmissable were not edge. And that evidence, your own evidence from your own trading, builds something that no external instruction can provide, a genuine experiential understanding that the market will always produce another opportunity, that this move, right now, is not the last one, that discipline today is not the cost of missing profit, it is the investment in consistency tomorrow. The market will always move, but edge appears rarely. Wait for the edge, every time, without exception. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video. Until then, control your mind.